Nerd alert! Learning is important, right?
Yes, exactly. What a bunch of nerds.
Nerd alert!
Right. Hello, and welcome to The Marketing Architects, a research-first podcast dedicated to answering your toughest marketing questions. I'm Elena Jasper. I run the marketing team here at Marketing Architects, and I'm joined by my co-host, Rob DeMars, the Chief Product Architect of Misfits and Machines.
Elena, I woke up going, man, I wish I could learn something today. And then I looked at my calendar and I'm like, nerd alert, let's do this.
What a happy coincidence. We're back with your weekly Nerd Alert every week. I'll take a deep dive into academic marketing research and translate its complex ideas into simple, understandable language for Rob and, of course, for all of you. Are you ready to nerd out, Rob?
Yepper.
All right, let's get into it. As always, we'll link the research we cover in the episode notes. This week, I read The Impact of Advertising on a Company's Stock Price by Shubha Srinivasan from Boston University and Dominique Han-Sessens from UCLA. This was revised in the fall of 2023, so it's a recent one. Rob, to start off, have you ever bought a company's stock after seeing their advertisements?
I really don't trust myself buying stocks. That being said, when I was in college, like right when I graduated from college, the late 90s, I always loved Apple and I loved their commercials, of course, famous Shy Day ads. And I did go out on a limb and I bought Apple stock at like $26 a share. And then it plummeted down to $13 a share. And then I sold it. So after that, I don't trust myself buying any kind of stock. So except for Apple, I can't say I have.
Okay, well, that's fair. I'd say if you were someone who buys stocks, you probably would be impacted by advertising. I don't want to spoil it too much, so let's get into the study. This study looked at research from more than 250 journal articles on advertising's effects on firm value or stock price. The authors start off by acknowledging that we have well-defined methods for measuring tactical marketing results. For example, marketers have become excellent at measuring the sales response from an advertisement, even the sales response from harder to measure channels like TV. But when the objectives are more strategic, things become a little ambiguous. So can advertising boost your market share, your brand equity, or your customer loyalty? While most marketers agree these achievements are possible and might even be more important than tactical results, strategic marketing results are not as easy to measure. And these authors have one specific metric in mind that's the focus of this paper, and that is stock price. The authors chose to look into stock price because it is a consensus metric that reflects the firm's expected future earnings, also adjusted for risk. So it tends to be a good metric to judge how a company is doing. Now, one thing they discuss right away is how investor behavior differs from consumer behavior. While many consumers may react to marketing in the short term based on immediate needs, investors are depicted as forward-looking, basing decisions on future expectations of the company. So, Rob, I wanted to ask you this. Do you think that public companies make some advertising decisions for customers and others for investors? My blink is the focus must mostly be on customers because, judging by this research, there's not even consensus that advertising drives stock price. But what do you think? Do companies ever make marketing decisions more for investors?
You can see it with the larger companies that have more money to throw around, where they will do an ad that goes to multiple audiences, not just their core customers, but also their employees. And of course, yes, their stockholders for sure. Just those big anthemic feel-good commercials that cost millions of dollars to produce and millions of dollars to run. I think you definitely find bigger, especially it makes sense, blue chip companies that are traded on the stock exchange, that they'll make those investments.
I guess you can see that too, not just through TV, but I was watching like the NHL playoffs were on at the gym, and like Caterpillar had a giant logo in the middle of the ice rink. And I can see sometimes those bigger sponsorship decisions, maybe they're made towards like, yes, consumers, but also if an investor sees that, they're going to automatically think, oh, this company must be doing well. They're paying for big sponsorships. All right. So we'd both agree, I guess, that yeah, sometimes they're making decisions for customers and sometimes for investors. Well, this study references the efficient market hypothesis. This suggests that stock prices adjust quickly to new information, reflecting collective investor judgment on a company's future potential. So a critical question within this research is whether investors recognize the future impact of marketing actions, even if they don't result in immediate earnings improvement. like Cat's logo in the middle of a hockey game. That's probably not going to improve earnings right now, but would an investor see that and think, oh, this company must have a good trajectory? Well, if the answer is no, that means that marketers are pursuing some long-term results at their own peril, aka as a marketer, you're really only going to be rewarded for your short-term results. And it's not easy for these researchers because it's hard to isolate the impact of advertising on stock price. But this study, it distinguishes between direct and indirect effects of advertising on firm value. So an indirect effect, that would be advertising increasing a company's earnings by boosting sales, which, if unanticipated by investors, can lead to stock price increases. This relationship relies on the ability of marketing's actions to translate into higher earnings unexpectedly. And then direct effects would be marketing creating market-based assets like brand value that investors might anticipate will enhance future earnings. So this route is less tangible and relies more on investor perception and sentiment. The authors looked at 250 journal articles and they categorized the impact on stock price as positive, neutral, or negative. Their findings indicate that advertising typically has a positive effect on stock returns. This positive effect mainly comes from strengthening the brand in investors' minds. They found synergy between advertising increasing consumer value and investor value, except in the case of price promotions. Investors see that as a signal that the brand might be struggling. So, Rob, what surprises you more there? That the positive effect is mainly from strengthening the brand in investors' minds, or that price promotions are a signal that a brand is struggling?
I think it actually makes sense that if you're doing too much promotion, it looks like you're fire selling your brand versus being able to do higher level feel good commercials show a sign of strength. I think that makes sense. It's interesting, as I was listening to this article, for whatever reason, and they're famous for not advertising, but I was thinking about Tesla because their stock has really declined lately. And many people will say that the reason why it has done so well is because of Elon Musk's ability to capture media and to communicate the brand values through that. And obviously, lately he's struggled a bit, and the stock price has struggled accordingly. And I also wonder with their focus right now on price, because they have been one that has not focused much on price. And now they've even within their own brand created less expensive models. Is that denigrating the stock price? Now, that's just an example of one brand. But I do think that the public perception is the more you have to lower your price point, the less attractive your offering must be to the marketplace. And therefore, that could impact your overall share price. That makes sense.
That does make sense. So the authors found that stock price movements can influence future advertising decisions that are not always in the firm's best interest, like reactive spending or cutbacks during decline. So it's not that stock price movements, they're always being benefited from advertising. They also discuss the rise of digital advertising and the focus on short-termism that has brought, and how digital might impact advertising's own impact on stock price, since offline channels are more known for driving those long-term results. And of course, there are a lot more questions to answer when it comes to advertising's general relationship to stock price. One quick thing I wanted to share, there's a chart at the end of this study, and it shows the market variables they analyzed and how they impacted stock price. So advertising expenditures, those mainly had positive stock returns. So that's kind of the conclusion of this study. But there were other things that also had mostly positive returns. That included customer satisfaction, new product introductions, positive social media sentiment, and just overall social media volume. So that's just the amount being shared on social, both positive and negative. Those had only positive or neutral findings. R&D expenditures had mixed positive and negative findings. And then when it was very clearly just negative social media sentiment, that had a strong overweight of negative effects. So for your Rob GPT, I asked it to summarize the study, and it said the study explores how advertising impacts a company's stock price. It reveals that advertising generally boosts stock prices by strengthening the brand's perception among investors. The study distinguishes between direct effects, where advertising builds long-term brand assets, and indirect effects, where it enhances short-term earnings unexpectedly. It also discusses how stock price movements can influence future advertising investments, and it might not always be beneficial. For example, if a company's stock price is struggling, the first instinct might be to cut advertising. All right, Rob, how'd I do? What'd you think about this one?
I'd be really interested to learn what magnitude the study feels a stock price can move based on the investment made. I mean, that would really send a clear signal to Wall Street to go, wow, you should be investing a lot more. If you can move your stock price by a couple points, I mean, the amount of work that companies think about in terms of moving a stock price, even a couple points, if we're saying we can do that with advertising, it seems like a highly under leveraged opportunity for a lot of these publicly traded companies.
I can just imagine that conversation might not go over really well in certain public companies, but we've seen with our own clients, we've seen a clear change in stock price that, again, like there's always other effects, but we've been able to really say like, no, a lot of this is due to television. And again, like they said in the study, television is going to have a different type of power than doing a big digital campaign because you're going to be reaching people like investors. And so, yeah, I'd be curious with this study too. Can we look at the companies they analyzed, and out of the ones that had like a positive return on stock price from advertising, what was that advertising? Was it mostly TV? I would guess it's mostly offline, or that played a big part in it. That'd be interesting to know.
And it's kind of a chicken and the egg. When you think about our own advertisers, TV has been really important for driving business results, which will then obviously drive stock value, versus is the advertising driving stock value, which then makes the overall company do better. It's like, yeah, it's interesting.
This is not investment advice, but judging by the study, it seems like if you were to be someone who picks stocks based on advertising, based on TV ads, it might not be the worst idea. Again, not investment advice.
Having sold stock at $13 a share for Apple, yes, this is not investment advice.
That's it for this episode of The Marketing Architects. We'd like to thank Ayana Klafhockey for producing the show and Taylor De Los Reyes for editing. You can connect with us on LinkedIn, and if you find the show valuable, please leave us a rating and review. And if you'd like to hear more from us, subscribe to our weekly email newsletter. It's built for marketers seeking research-first analysis of the latest trends. You can go to marketingarchitects.com/newsletter to subscribe. Now go forth and build great marketing. This stuff is so confusing. I'm like, am I stupid? That's how I feel most of the time reading this stuff.
Imagine listening to it for the first time while you're on a podcast.
I know. I'm sorry. Some of those questions, I'm like, would I be able to answer this?